Welcome back. Philip, you were talking about bonds and asset correlations and that there could be some upside coming back in the bond market. Now, we know that bonds are tied to interest rates. How are you reading the yield curve? What is it telling you now?
Well, the yield curve is very much inverted, meaning long-term interest rates are much lower than short-term interest rates. But that's a reflection of the market expectations for rate increases out of the Bank of Canada or out of the Federal Reserve. I think we've seen the widest that we're going to in terms of the inversion of that yield curve. And over the course of 2023, we should start to see that yield curve flatten out again. And how that's going to work is that shorter term bond yields should start to come down as expectations of the Bank of Canada being done with its rate increase starts to be priced into the market. So long-term bond yields, the 10-year yield and further, even I would argue the 5-year yield to an extent, are likely to be anchored around their current levels. But it's the short-term bond yields that are going to start to fall and then push that yield curve back into a positive slope. What this is saying is that it's going to be a better year for bonds in 2023 and beyond than we saw in 2022, which was the worst year that we've seen in my career or perhaps in the last 100 years.
Yeah. What does it mean then for the rate cycle? You mentioned looks like it's pricing in the end of it. Certainly seems like that from the tone that we're getting from at least the Bank of Canada. Are we close to the end of the rate hikes?
We believe we are. We believe that we've seen a peak in the interest rate cycle or are very near it within, say, 25 to 50 basis points for the Bank of Canada, similarly for the U.S. Federal Reserve. So peak in interest rates, peak in inflation at the same time. And so the work that the Bank of Canada has done through 2022 with raising interest rates, trying to slow inflation down, is having an effect and will continue to show that through the economic data in the first half of next year.
Okay. And yeah, you're seeing, that means they have to believe that the interest rates has actually curbed demand. And you're seeing that reflected in, say, retail sales and investment?
You are. You're seeing it mostly in Canada in the housing market.
Yeah.
The very, very sharp declining housing prices, housing activity, investment. So what the Bank of Canada has done with raising interest rates as much as they have is having an effect. And we'll continue to see it. Now, the impact by raising interest rates tends to take anywhere between 6 and 18 months. So what we've seen out of the Bank of Canada this year really still is only at the start of being felt in the economy, but it'll continue to permeate through at least through the first half of 2023.
So you don't think they've overshot then? Is there a risk of that?
There is a risk of it, but as the central bankers have said, and I agree with them, they would rather overshoot because it's easier to cut interest rates than undershoot and try and rein in inflation that might be running hot.
Okay. Now, Philip, you're in the camp too that we could see a recession next year, but you're not expecting a deep one. Why is that?
Well, because this is going to be this is a recession that's been triggered by different factors than what we saw in 2008 or what we saw, say, in the early 80s. Typically, a recession comes about by a buildup of excess in the marketplace. And we've had that to an extent in terms of all of the money that got into the economy following the COVID lockdowns. That was necessary, but it wasn't for an extended period of time. And we measure this through the money supply increase in Canada, in the United States, and around the world. It was like a one-time shot to economies that has since then dissipated. And so we don't think that because this has been a very truncated expansion from March to June 2020 to where we are today, this is going to be, I think, a truncated recession as well. The worst recessions tend to come with some type of financial calamity or collapse. Well, we don't see that. The banks are very, very healthy. Credit conditions are quite fine in the United States and Canada. It's just interest costs are higher than we've seen for a number of years. That's just going to slow things down. I really describe this almost like the hangover from a very, very big party that we just celebrated in 2021, but it shouldn't be bad or extended.
Okay. Just 20 seconds to the next break. Employment picture still looking good to you?
for now. But remember, what the Bank of Canada is trying to do is slow down inflation, and I think they're focused on wage inflation, and so they would like to see that unemployment rate take up, perhaps from 5.5 to 6.5%, just to make sure that we don't see extended wage pressures.
Okay, we'll take another quick break. We'll be right back.